This is the Ned Group Investments Podcast, a space where you can learn more about our fund managers, the funds they manage, as well as getting up-to-date and important developments affecting the investment world and how they might be relevant to you.
You said in one of our recent meetings that South Africa have the highest rates in the world for the quality of the paper.
Yes,
do you believe that?
I still believe that. And I think, South Africa has a kind of a mix in terms of economy. We have a first world scenario in terms of infrastructure and in terms of the banking system, which is one of the best in the world. And so I think what happens in an emerging market scenario is that a lot of people use South Africa as a proxy for emerging market, especially the currency and some of the bigger investments in the banks and things like that. So we often get the flows through the currency when people are trying to move money or move exposure from emerging market currencies very quickly. And then later on, they will then rebalance. But South Africa gets the brunt of that movement. And that's why we see a lot of volatility in the currency, often when there's emerging market events that are happening. So I think a lot of investors worldwide look at South Africa as being almost first world, but without the fiscal policies to back it up and the maybe not so stable government. And we're also in the right time zones because we're aligned to the European markets. And I think compared to maybe the South American markets or the Asian markets, it's easier to understand the South African environment regardless of all the political issues that we have. So I think South Africa from that perspective has a very good reputation in the market. And that's why people are willing to invest in here, because yes, our rates for the level of the quality of the infrastructure, the financial infrastructure that we have is very good. And so it's attractive for especially speculative guys with hedge funds and stuff looking to get returns by speculating on our bonds and on our currency. It's easier for them to do so because we have a very liquid and sophisticated market. And so making profits in South Africa is a lot easier than doing it in some of the other more far-flung emerging markets.
I think the statistics back that up. There have been 4 odd months of positive, consecutive months of positive buying of our bonds by foreigners. Yeah. Ray, have you changed the way you manage money based on these tight spreads and the very low appetite to issue by the traditional issuers? And have you noticed anyone else changing the way they manage money in this market?
Yeah, so we haven't actually changed the philosophical way that we manage money. We still, one of our main philosophies is to immunize the portfolio against interest rate risk. And we've done that for 15, 20 years. And it's worked very well for us because we've always been able to outperform the benchmark that we've been set over all investment periods. And so we're not doing anything different. What we are doing is taking into consideration the potential risks. So we could choose to hold higher or lower levels of liquidity, for instance. And we now, at this point in time, choosing to hold higher levels of liquidity because we've seen the nervousness in the market. And we don't want to be in a scenario where clients come to us and ask us for their cash and we're not able to give it to them. To be able to back that liquidity requirement up, you need to have assets that you could sell quite quickly that are of high quality and that are very marketable. And that's where we come into holding less risky credit assets in the sense that we're holding mainly bank assets, stuff that we can sell relatively easy, that people understand, nothing complicated in the portfolio. We've stayed away largely from sort of higher risk corporates and instruments that may take a bit longer to sell in the market. So that's what we've done differently, is really in preparation for any kind of crisis that may come about as a result of the downgrade. But that's easy to change again back to a more normalized scenario when we see the outcome of maybe a downgrade. When things start normalizing again, it means we're sitting on a lot of dry powder in terms of cash. We can go out, and when credit spreads start normalizing in, we can actually start buying assets that are going to be starting to give us higher yields, and normalize the diversification within the portfolio. But at the moment, we'd prefer to stay more concentrated into the banks, which in our view is low risk, even though there's a greater concentration. It's low risk because the banks are systemic in this kind of, they're systemically managed industry in this country because the Reserve Bank sees them as potentially risky to the environment if they're not kept in good shape.
Something I've heard a couple of times from clients is the question, how do I get more yield? What's the response to questions like that?
Well, it's easy to get more yield. You can just take more risk. And so there's a range of income portfolios available in the market. And that risk can come from various sources. It could mean that you take more credit risk. So I could be lending to corporates that are down the rating scale or new businesses that they maybe don't have a track record for. I can get much higher yields from that. But then obviously you're taking a number of risks there, obviously credit, but also liquidity, because those are not instruments that as a fund manager I could sell very easily should you require your cash. So, there is that kind of potential to increase your returns, but with it you're taking additional risks. I mean, you could put in foreign assets, for instance. You could go and try and find assets offshore. That's maybe potentially something to do. But obviously if you rand based and you want your returns in rands, you don't want to be taking currency risk, then you obviously don't have that option. But I mean, there are various ways of doing it. And, we've just tended to stick to more conservative philosophies in the funds that we manage for Ned Group. Is we want people to come in and know what they're getting. They must be able to get the consistency of getting the returns above their benchmarks that they're expecting under all circumstances, that they're able to come in and get their money out when they need it and not take any capital losses on that. And so those are the sorts of things that we're trying to make sure that we try and achieve for the clients that come to Ned Group.
And you've said before that there are times when the extra yield is not worth that extra risk. Do you think this is one of those times?
Absolutely, and that is currently what we're doing. So by risking the portfolio in terms of credit and liquidity, we're actually reduced the yield on the portfolio slightly. And it's, we're talking a few basis points here and there. But by doing that and reducing the expectations of clients, what we're doing is we're actually giving you a much more robust investment that is still giving you yields that are very competitive against everybody else. So you might have the option to go to another manager that's yielding 20 basis points higher than we are. But then you'd have to look into that portfolio and see the kinds of risks that portfolio manager is taking. And we don't believe that you can get any higher yield for the level of risk that you're taking in the funds at Ned Group. We are giving you what we believe is the market best yields for that level of risk.
State-owned enterprises keep coming up in all discussions in the fixed income markets. Where are they at the moment? Do you see us playing or our funds having state-owned enterprise paper in the future, and how are you positioned at the moment?
So we have very little exposure to state-owned enterprises at the moment, and for a number of reasons, mainly from an ESG point of view, from an environmental, social and governance point of view, mainly because of the governance issues in a lot of these entities. And we don't believe that it is responsible for us to invest client money into entities that are not prepared to maintain good governance and run businesses that are socially responsible. And so therefore we've not invested in the SOEs at the moment. And then also from a financial point of view, a lot of these businesses are under strain at the moment, and they're trying to raise finance from the government. And so we need to be able to see a much more stable environment when it comes to SOEs before we start looking at them and putting money into these entities. And we also need to encourage them to start doing the right thing in terms of the environment. I mean, we've got Eskom that's running old power stations, and not because they have a choice anymore. They have to do that to keep the lights on in South Africa. But these are causing massive pollution problems. And what we're trying to do is to work with our management teams to say, look, we're happy to invest in your businesses and get, rewarded for it in terms of decent yields. But we need to see you making a change in the environment. We don't want you to be pumping pollution into areas just because you want to make higher profits or you want to get the business out of potential financial issues. So it's a trade-off between getting financial returns and making sure that we manage all these ESG issues that are coming up for our investors, to say we need responsible people out there, and we want the right type of governance that's going to be able to make this change happen financially as well as environmentally.
Well, I'm sure my bosses at Nedbank, the money managers who do good, would be pleased to hear that ESG's taking a bit of a front seat. Ray, many thanks for your insights.
Ned Group Collective Investments is an authorised collective investment scheme manager in terms of the Collective Investment Schemes Control Act. Ned Group Investments does not provide advice on financial products and will only give you factual information. For further details on our funds and to view our terms and conditions, please visit nedgroupinvestments.co.za.